One of the things we look at is this business built from the heart or the head.
Leon, thank you so much for joining the podcast.
No problem. We really do go down to a granular level because what we want to make sure is customers are sticky.
In this episode, I'm speaking to Leon Hughes, partner at Piper Equity.
Piper's view, and I give first-hand view, and that is bringing something to the table more than cash. Our purpose is to build brand legends. You look back, every single one of them has got a story.
Leon's career started back in the early days of e-commerce, building his own web design agency before most brands were even thinking about selling online.
We think now with the internet, the experience has to be as better, if not as good as the product.
From there, he went on to lead e-commerce at GSK, helping scale the digital side of the business globally.
A brand has to be, possessive, and there needs to be a community. With the heart, you've got the emotional territory. You can see how the community can latch onto it and believe into it.
This episode, we are getting into what founders really need to know. What makes a business investable? What drives the valuations? The mistakes that cost you leverage, and the signals investors are really paying attention to.
We spend a great deal of time looking at the retention rates, the lifetime values. We were investing at the business. The revenue literally dropped off a cliff, and that can happen any time, but it happened during.
What can a founder do to get a higher valuation? Leon, thank you so much for joining the podcast.
No problem.
Yeah, absolute pleasure having you. Tons of questions to ask you about a subject matter that I actually don't know a lot about. And I'm hoping that it's also going to be useful for founders out there trying to raise capital right now. One thing I want to do is maybe start off with asking you kind of a fairly, sort of icebreaker question, if you like. What's your journey been over the last 20 years or so?
It's actually very unique for someone like me to be in private equity, let alone Piper, which I'm completely privileged to be in Piper. Just take on Piper initially, and then it might be worth giving you a bit of background to myself. I'm a partner at Piper. The journey is quite interesting because I actually was a recipient of a Piper investment back in 2004. So I was on the board, I was a director of a business, and Piper invested. So that was 22 years ago. They were on the board for 3 years. Two of my colleagues at Piper were on the board with me. They were invested for 3 years. And then 5 years after that, we sold the business. And I reached out to Piper and said, look, we stayed in contact. I loved being on the board with them. I saw what they had brought to the table. And quite frankly, I wanted to do that. So, I don't come from a financial background. I'm more digital, techie geek. In 2012, I joined Piper with the view of helping all of the brands with their digital capabilities. That's my bread and butter. But of course, that's now 14 years on, more rounded investor, sits on boards, on the board of Ancient Brave and Inside Travel Group, where whilst I'm focused on strategy, I also bring the kind of digital expertise to the table. And now I'm partner owner of the business to help drive it forward to the future. I suppose if I take a step back, I graduated from university and I actually set up in 97 a digital agency at the cutting edge of the internet, myself and two other colleagues. And we were building websites. And actually the first website we ever built, which makes me shiver, was an e-commerce website for the biggest stationery business in Europe. So
Wow.
three graduates coming out of university took it on, and we actually delivered it. And I think it was right at that kind of bubble whereby there wasn't any Shopify, there wasn't any Magento, etc. And so we had to hand code it ourselves, which was a bit of a learning curve back then. Then we started taking on huge contracts, Ferrari, Dell, PowerGen, brands of the past, and we grew. But then the bubble burst. Unfortunately, we were slap bang in the middle of it. I think we were opening offices in Sydney. We had 2 offices in the UK. And that's where my naivety came into it as a kind of founder starter. We had personal guarantees. I had to put 15 people into redundancy. So I put the company in administration. That 6 months was a bigger learning curve there. And came out at the age of 23 with some major debts. So actually, that's why I'm in awe and sympathetic to founders and yourself. Who's got a digital agency, there's ups and downs, but Christ, I couldn't do that. I couldn't do it again. And I was balancing numerous jobs. I got to meet an incredible founder called Zeph Eisenberg at maximise, who I fell in love with, and I built out his maximise D2C arm. And if you think about it, that was about 21, 22. It was pre-Google AdWords, pre-Facebook. Again, I used my know-how to build out the website. We built out the warehouse management system, the CRM. There was no tools available back then. And we grew. We were the first to adopt Google AdWords. We were the first to trial of Facebook advertising. There was no case studies. It was very much a test and learn environment. But I suppose it was in a decade where it really cut my cloth and took a business from 0 to 100 million. We sold the business to GlaxoSmithKline for 162 million. Became a global e-commerce lead for the consumer health division, but I'm not corporate. And that's where I reached out to Piper and just said, between 2004, 2007, I love what you brought to the table. I want to help brands like you did with Piper. And that's how I got into it. So my journey has been set up a business, fail that business, very sympathetic, then helping businesses. And I suppose helping business not fall into the same mistakes that I fell into. Gone to private equity, because I worked with a business that was backed by private equity. So I'm not an accountant, I'm not financial, etc. So that's why I said it's very unique for someone like myself to be in the situation, a position I'm in.
Very interesting. So I guess what you're saying is that private equity firms are typically run by people with financial background, right? And so bringing in the diversity of skill set with yourselves and, more digital experience, is that like highly unusual nowadays? 15, 16 years ago, perhaps the scene was a little different.
Yes, and I think that's what kind of differentiates Piper. Piper last year was our 40th year. I've known the guys for 22 years. They were going 18 years prior to that. I think what's quite unique, it was founded by two branding consultants, not finance bankers, hedge fund guys who put some funding together and know how to make money. These were brand consultants. A vision for Pub of the Future in the UK. They actually set up Pitch and Piano. That was their concept. They decided to give it a go. That brand consultants in daytime, public policy evening. They went through the whole kind of startup to scale up to exit phase, and during that period, they realized you could raise money, but actually, if they had the strategic advice at the time, they could have made it a bigger business, or they could have done it much quicker. So when they exited very successfully, they decided to use a pot of money to start up a fund, which was really about supporting UK brands, but also bringing that expertise to the table, specifically in brand, because that was their know-how. Pitch and Piano, they're great at hospitality, but they were still branding consultants at heart. So where I have come into it, realizing it's not just brand, it's people. So we've got internal expertise with regards to helping our brands think about people, culture, even succession. And we've got an incredible black book because we've been going for a kind of 40 years. So we help all our brands with talent. Digital, going through the early 2000s, was got a natural progression that if there was another pillar we can help our brands with, it would be digital. So I think it was a combination of right time, experience with the brand, what Piper embodies. When we invest, we support the brands. It was a natural progression. But I suppose what was fortunate, tried and tested me. They got to know me, to build a relationship. I think that is hard to replicate. Certainly I haven't seen it in, competing funds. There's other competing funds that billions, and they have huge teams. We've kind of found our sweet spot. We're very family orientated, and there's 18 of us based in Notting Hill. We manage a fund of 100 million. I know that sounds huge. This is our 7th fund, but every fund that we've raised has been around about that amount. So our team size is held as it is. We've got a team now moving forward. We're comfortable with our investments, what the type of checks we write, but also the fact that we've got about 12 to 14 brands at any one time. It means we can help partner, like I said, not just with the cash, but also the support. Whereas others, when they double, triple the fund size, take on expertise, which kind of dilute that added value.
Yeah, just in terms of the way you like to do business at Piper. That totally makes sense. Thank you for that intro, and fascinating kind of what your journey's been like and how different it is to, I guess, most people's path to a PE firm. Coming on to the kind of the questions that listeners would be really interested to hear more about would be, what does a PE firm like Piper like to see in a business when they have their investment specs on? What kind of things are you looking for? What makes a business investable?
It's worth giving you a bit of background with regards to our approach as well, because I think we're very different in the sense of we want to go on the journey with the founders, very early stage. Alluded to the fact that at any one time we've got 12 to 14 businesses. And it is with your listeners looking at www.public.co.uk, taking a look at our portfolio. You'll see our existing, but also all the previous fantastic brand legends we've partnered with over the years. It gives a bit of taste of who and what we invest in. Fast growth consumer brands, but it's really backing founders and brands that want to make people's lives healthier, happier, more fulfilling, while also, very importantly, help them minimize the impact on the environment. That's kind of our purpose-led vision, distinctive brand identity, differentiated product and experience. We think now with the internet, it's not forgiving. The experience has to be as better, if not as good as the product. A brand has to be customer obsessive, and there needs to be a community surrounded. There's key 5 metrics that we look for, but there's several stages. When we meet brands to begin with, proposition that we end up investing in down the line can be very different. So we spend a lot of time with startup, 12, 14 in their business at the moment that we're partnered with, but we're talking to about 378 brands, UK brands in the background.
Wow. Right.
We're going on the journey with the brands. We're investing our time to support them, to give them advice. We get to know them. We get to know the founders.
Right.
And that allows us to evaluate all those 5 points to a point that if we can get to a level, our minimum investment is about 6 million. So you typically, a brand has been going for 4 to 5 years. They've gone through the kind of infancy stage. We say we're transcended to adolescence. They've got a bit of process, this pace. They may have gone through several rounds of investment with us, SEIS, CIS, angels, etc. And basically, we are the investors which actually take it to a trade buyer. We're kind of the last investors to sell to likes of Mars or Nestle or Chanel. So we kind of help put that governance in place and rigor to make it an attractive asset. Different stages we look at. Right at the beginning, it's as simple as getting to know a founder who's got real grit, vision, purpose-led vision that we think, wow, there's something about it. It's got a product that's better and different. But we consumers, we want to enjoy, we want to nurture, we want to help influence those brands. And then through the stages, there's so many different factors, whether it's looking at the model, the CAC, LTV. You just got to make sure the business model and the mechanics work so it's delivering profitability, but at different stages of their growth.
You mentioned 5 things. I'm going to ask you a cheeky question. How many have you mentioned already in that answer? What are we missing? What have you not mentioned?
A PE level, we invest 5 million plus. Do a lot of due diligence, and our fund is 100 million, 10 million. That is our own personal money. 90 million of that we're looking after for our investors. And you're only as good as your last fund. I think we've been going 40 years. You've got a good track record. We've got phenomenal lens. We can make a quick decision whether that's one for us in the 6 sectors that we're looking at. Have to factor in scale. As a startup, and I've been there, it is scrappy. You have to hustle. You have to plaster over. It's not going to be perfect. So I think during that process of growing with a brand, giving them advice, there's the soft elements. Brands, does the founder listen? Do they want our advice? Because we use that as a bit of kind of a nurturing due diligence phase. Say, right, let's invest and let's invest quickly because this is one to back. That's slightly different to a lot of kind of investors. We invest a hell of a lot of time, effort, getting to know the business and the founder the years.
So it's not just about the opportunity to make money. It's more about kind of the founder and their approach. Because, I hear a lot about story and signals. Story is very much the qualitative side of it. Have they got a good story? Is it going somewhere? Do they have great, as you mentioned? And then there's the signals, which is more of what the commercial's looking like. So I guess before you even get into the commercials for you, it's, do we think that we have a good fit with the founder? Can we see ourselves working with this founder? Do we think the founder has the vision they can do what they say they can do? Those are the kind of things.
Absolutely. And the proposition that we invest in will change. And the founders that we meet originally when they have the startup idea, it will change. You have to move with the environment. But it was interesting what you said, because one of the other lenses we have, it's so easy to set up a business nowadays. AI is automating a lot of aspects, sourcing. If I think back at Max Muscle and the heavy lifting we did, it's like, oh my God.
Hard coding everything. The good old days of hard coding.
Wow.
Yeah, line by line.
Automation, CRM, swim flows, so all of those kind of things, it's a dream right now. So anyone can set up a business, anyone can source products, and it's easy to reach out to target communities, especially when you're a startup. It's really cost effective, but as you start scaling, the CAC start and performance marketing start to put pressure on the business. But one of the things we look at when you say about stories and purpose led, and probably you'll see from a lot of the investments now in our portfolio that I've mentioned, is one of the quick filters is this business built from the heart or the head.
Interesting.
And actually, with the heart, you've got the emotional territory. You can see how the community can latch onto it and believe into it, where the brand is made from. Because our purpose is to build brand legends. You look back, every single one of them has got a story, and it's from the heart, not the head.
This is getting even more exciting. So you're speaking to founders, right? You're meeting them at events or wherever you're meeting them, and then let's say the conversation gets into, okay, let's look at your books, let's see what's happening. Are there any signals? So particularly talking about performance sort of KPI led due diligence, and this might be very early stage if you like. I'm not even late stage just yet. But as you start looking through the business performance, are there any signals that the founders themselves kind of underestimate? They kind of think like, PE firm's not going to be interested in that. Is there anything that the listeners might be like, oh, wow, I didn't think PE firms would even be interested in finding out about this one particular metric, for example?
Okay. It's very good. So I'm a digital person, so I'm all over the kind of numbers. Again, it's what we said, we're very sympathetic. We're sympathetic of, a stage of growth. So you might not have the people in place. You invariably don't have the dashboards of KPIs. We bring back a lot of that table, even when we are, investing 10 million and we're putting the board pack together. I've got a dashboard of KPIs, which is quite generic, that I share, which I've built up over the years. Actually, it's what I put in place in Maximise on. As you said earlier, the signals. I think the key thing for us is just to make sure that those are tracked by month, by year, so you can visually see the seasonality, you can see trends, you can see where an overinvestment has an impact on conversion rate, a whole bunch. And that includes email signups by territory, just making sure that as you're growing, you build in a pot that you can market to, so you're not over-reliant on paid performance. Many brands would think that we're looking at that granularity, but we are, certainly because of my digital background, we're looking at conversion rates, we're looking at the whole cohort of, and at a granular level, 3-month lifetime value, 6 months, 12 months, 18 months, the CAC during those months, the seasonality. We really do go down to a granular level, because what we want to make sure is customers are sticky, the product works. There's real efficacy, because we're in a world where, a commodity out there, you can have what makes your protein powder better than someone else's when they're all by the same supplier. So we spend a great deal of time looking at the retention rates, the lifetime values, also the definitions as well. We help brands understand that, lifetime value is contribution, CM2, fulfillment. What's the margin we're making, and how much you spend to recruit that customer? Okay. I mentioned, 3-month stages. Why do we do it so short? Actually, if you look at the 3-month cohort versus a previous 3-month cohort, all the way back through months and years, you can see, is it going in the right direction? Because if it is, you can say the 12-month lifetime value is on target or growing, which is a dream. You can act on it really, really quickly. And it gives us kind of, we want to de-risk a decision to invest. Why are we going to put 6 million into this? Well, we'll be presented with a plan, and that plan that invariably changes. We model it ourselves, so we go in at a very granular level. We find ourselves, because it's not that we are just offered up a opportunity. I suppose we want to get involved with businesses to help kind of mold what to expect, what are those KPIs we are looking for. So we kind of roll up our sleeves, we get involved, we give them a steer, because actually what we want to do is, when it comes to due diligence, have it all in place, pretty much.
Well, you're setting the exam paper and just handing it right to them and just like, look, this is how you succeed.
Lots of businesses that we haven't been able to invest in because they just flown. But what's great is we still got the relationships with the founders. They still want to be part of our community. And we learn a ton.
Thank you for sharing the insights around kind of signals and due diligence that goes into an investment. Leon, next question I wanted to ask you was, as you're speaking to founders, you're getting to know them, perhaps they talk about their commercials as well. Are there any red flags that immediately kill interest from a PE firm like yourselves?
I'll go back to say, the founder, typically the investments we make are founder-led businesses. We invest typically for a period of 4 to 5 years. Okay. And if you think about it, because we spend a lot of time helping in the businesses, it's a true partnership. And like with any business, when you go into a partnership, you want to make sure you are committed, invested in the right people. Because there's going to be, yes, hopefully, huge opportunities, massive growth, etc. But there's going to be curveballs. Tricky. There always are. I've never been in a business whereby there hasn't been challenges. Look at that. The last 5 years, who would have predicted COVID or wars or tariffs, which has all impacted our businesses. So we've got to make sure that we're a founder or founders that, there's mutual trust. There's support for each other. There's no skepticism about private equity. Well, what is their objective? We have a clear objective, and we want to put our heart and soul into it as much as the founders. So away from all the metrics, away from the growth of the business, I suppose we want to make sure that we can have a good relationship. And I think, again, that nurturing process, getting to know each other, it's not just about business, it's also on a social level. You mentioned the events earlier, and love hosting that to get to know one another, apart from sharing insights and thought leadership. But during those process, and those interactions, we're actually working out, would I love to be on the board with that person? Are they taking on board the messages that they're hearing? And we do that in various forms or shapes, whether it is that socializing the event, watching them, cheering what their team, are they as passionate as you, which helps us with that kind of heart, head. And gramming enough to talk to agencies that work with them to say, are you seeing the same thing that we're seeing? It's quite a lot of our due diligence of making sure that when we partner, it's a true partnership, regardless of the KPIs. Okay, so there's a bit of a softer element. And there's been some incredible businesses that we have declined to work with because we just didn't think it'll be right for both partners. The other red flags, typically when we're at a level whereby you're looking to invest a considerable amount of money, 10 million, we've got to do due diligence. And we do diligence, commercial, legal, finance. We've got to make sure we've got an obligation for our investors to make sure we've checked everything, okay, apart from relationship. In all, it takes about 3 months, start to finish. Typically, we say about 6 to 8 weeks, kind of driven by the brand. It always has been that. There's delays in tax information or getting the accounts, etc. So we actually see a period whereby a budget has been put out there. We invest in, it could be the last 12 months, but certainly run rate and what we're looking to achieve. So you've got a period to access all areas and you want to make sure as a brand that those figures are achievable, deliverable. We have had instances where unfortunately just dropped off a cliff. It's a tough scenario to be in. It has been consumer led, but we are valuing a business. We're backing a business based on certain criteria. Not even the founders saw that come in. That's in a kind of blue moon, but it's say red flags. You want to see we're buying into your budget, your plan, your vision. And if you deviate, if CACs double or go up by a lot, you kind of sight alarm bells. And I suppose third would be just maybe a lack of understanding or incorrect information. And again, we've had, luckily not many, but a scenario whereby where the cohorts are just incorrect because they've been measuring them in the wrong way. And if you're reporting incorrectly, the whole team are basically working to those metrics. So we have seen some disastrous misinterpretation of data in this day and age. You just can't afford to do that. There's so many tools available that drives top of funnel where you invest in and influences the lifetime value.
I'm going to ask you an impossible question, a bit of a trade secret, trying to get that out of you. Let's see if you divulge. Every founder wants to get the best valuation possible. Your numbers are your numbers. What can a founder do, if anything, to get a higher valuation than what they might have in mind, or what the story that the number tells?
If I tip myself out to Piper, I think all of those 5 points that we're looking into score high. That's beyond the business metrics. What you're going to look at is a value in this business down the line and working back. Okay. So if you have the mentality that I need to give you every confidence that I'm here, but I'm going to get there. Okay. So over the next 4 or 5 years, I'm going to get there and this is the value it's going to command. Okay.
Right.
I'm saying private equity investors in general, we have to have a leap of faith to get there. Okay. There's risks and opportunities, there's external factors. But I suppose what you have got is that previous trading, say, right, we're not quite there. There are opportunities. This is a linear guide. We can, confidently say we can get this to these levels over the years. There's a lot of low-hanging fruit. We've proven at low-hanging fruit. So we're just looking to invest in more people or some marketing to open up the territory, but we've proven it. So I think if I were to do it myself, I would make sure all the proof points are there. So we could come along and kind of go, wow, there's momentum. They're saying, we could do this into £100 million business. Look at all the stats there. Let's look at all of the different contributing factors. And that says we just got to do more of the same thing. And it could be a case of, look, here's our MBD. That's for next buyers in retail.
Yeah.
We've got traction in Germany. We've got good a new territory, Germany, Spain, US. It's proof points. I think that gives us confidence in the momentum versus, just paying to acquire customers and saying, this is our growth. We're profitable. There's no stickiness. You can only acquire a certain amount of business. There's a certain addressable market in one country through NPD, through community building, keep the CACs under control. All of the due diligence points, if you tick all of the boxes and the 5 that I alluded to earlier, that just gives me confidence. Because don't forget, I've got to pitch it internally to my investment committee. I'm representing the brand, saying these are all the areas that I have faith in. Let's interrogate it, but on that basis, can we get a Nestle or a GSK or a Chanel interested? Who, quite frankly, the higher payers interested, if we can. That pushes up the valuation.
Very interesting. Next question for you. In terms of looking at kind of the milestones that founders need to be thinking about before they get into Series A, does it, obviously, you've laid out for Piper 5 million, they've been in business for 5 years, they can demonstrate traction. Is that pretty standard, or does it vary quite a lot, like from PE to sort of different PE firms?
Absolutely. And I would encourage any brand that get to the level where they need funding of 6 million, their research. You can pick up a phone to us. You can pick up a phone to anyone. You need to due diligence us, and that's one thing. Having received money from good PE and not having a great experience with another, that's one thing I encourage everyone to do. Look at the exits. To previous owners, founders. They'd experience post an investment, speak to any of our previous exits now, because we're current, speak to our existing. Just do your research and get to know. Also, as part of what is the criteria? Okay. So, for example, most venture capital will only invest in growth. Will only put business, which is called primary. Okay. And some insist on having a majority stake in the business. Some, will want to structure some deals with some debt, etc. You just got to shop around, reference, and find out which works better for you. As I've said, with us, we want to have a relationship. That's really key for us because we want a partner. But our model, for example, we are happy de-risking founders. We want to go on 4 or 5 years with them. We understand, they want to pay off a mortgage or be a little bit more comfortable for the next period, delivering us good growth. Why wouldn't you incentivize? You can clean up the shareholder table. There might be some opportunity there, but that's called secondary. So that's actually giving money and not putting money into the business. And from my perspective, we're completely flexible on that front. When we invest, we kind of do a clean upfront structure in the sense that we buy equity. And it's a straight equation. If you want to boost valuations, you can structure it by getting leverage. I won't go into the detail, but debt into the business, which is cheaper for us, but the valuation go up. And there's different ways of cutting it.
Right.
Some are strict. We are incredibly flexible. Most of our investments are minority. I don't think we've ever engineered a majority because that psychologically feels like, oh, we need to take more of a stance in a bit, and we don't do that. We back fighters and management teams. It's just worth, you can have a great relationship, you can get to a great valuation, but actually work out, does that model fit for me? And it's got to be said, that did change depending on the size of the business. As I said, we're normally the last investors, but you want to make sure that the investment you get on the way up there is not going to impinge on as getting involved. We want to make sure don't give too much away of your equity by the time you get there, because 4 or 5 years, you want to be referred to not at the stage that we're just in an auction. I refer to building that relationship up. And if I can encourage any of your brands, I would argue I'd probably speak to a lot of them anyway. But any of your brands, regardless of the size, just go forward. Come and speak to us. We want the best for you. If we're not the right fit, we'll tell you who is the right fit, but be on the front foot.
Next question I had for you was, do you typically see founders making certain mistakes when negotiating terms?
I was going to say yes, but not with us. I think it's not about making mistakes. I think it's the interpretation of some of those. And sometimes, so we, as you probably picked up, we do a lot of direct origination, getting to know the brands, etc. Then we feel comfortable. Inevitably, when we invest, we have got to put contractual agreements in place. It just happens that everyone does that. Okay. There are corporate financiers we work with that introduce you, but in some stages, we build up direct communication, and they'd be the ones to actually handhold you through terms. I found it weird when I came to Piper that, well, why are we bringing someone in to help? You have to, because you need someone there to interpret the terms on behalf of you. Because those terms are not just to protect us, also to protect you. And I think some of the brands get ETA as in, oh, you could take my shares away, or you could do this, or you could do that. You can enforce this. There's a cap on how much I can invest. But there's a reason. It kind of works to your benefit as well as ours. I firsthand experienced it with a brand that decided to do it themselves and got et up. To your point about, do you make mistakes on kind of terms? It's more about the definition of it. And then post, when we didn't invest because this person said it was not right to her, and we could have certain hold permissions, we could do so. You kind of sit back and kind of go, well, no, because equally you could do that. I mean, his response is, yeah, but I would never do that. And it's kind of, well, you got to protect something else. I think it's not about agreeing to the wrong terms. I think it's really understanding why those terms are in place. Yeah, I mean, the obvious one is agreeing to, I don't know, valuation that was right or wrong, and you don't have bitterness down the line. So you want to make sure it's fair for both parties.
Yeah.
So definitely spend the time and money, totally understanding it, but from an impartial view, because the mind can run away with, I'm letting go with the business, and you can take hold of it. And I think there's another element is just to look at the investor's background. That's where you should reference a lot. These terms that we agree with one business are pretty much boilerplate, agreed with everyone, apart from the value. Have we screwed them? You can find this quite quickly. I mean, it's quite nice for me because I self-reference Piper because I was a recipient of a Piper investment. I say, well, did that happen to us? No. Am I working with Piper? Yes, it could have been very different.
Yeah, makes total sense. In terms of the deals that, let's just say, all parties have agreed on terms and founder is happy with the valuation, etc., do you typically find deals falling through last minute? And if that happens, why?
No, But I think when you've got to a point, certainly from our perspective, when you get to the point, I mean, when you get to the point where you agree the heads of terms, the horror stories at the 11th hour, okay, ask previous, reference them. Has that happened before? So speak to previous investments, exits, or current. We get to a point whereby when we help engineer opportunities, because we've been nurturing the business over time, so we get to a point whereby you say, on the basis of what you're telling us, this is how we would calculate the valuation. So we propose that. And we thought through kind of the legal governance, the framework in which we got to work around before we then do all the due diligence. I can't remember a time during the due diligence that we changed any of that's kind of commitments, because that's bad rep on ourselves. But equally, I'd say the majority of investments where we've agreed the terms and conditions, we delivered on both sides. Okay. And it's a partnership. So we get to the point, we know it's a partnership. We're not going to do that to each other, right? I do remember one occasion, however, and I think this goes back to my point about red flag. We were investing and the business, the revenue, you don't want to wish this on anyone, but literally dropped off a cliff whilst we were going through it. And we've committed to a founder who has said this is the figure we're going to get to. And there was fundamental issues with the business. It actually was. They didn't raise in the end because they had to readdress their kind of proposition. And that can happen, unfortunately, at any time, but it happened during the criteria. Whilst it was a tough conversation to have, it was also quite an easy conversation because both parties could see it happening. And we were like, we have to go back to the drawing board here. So, but that was a one-off, an absolute one-off. I don't think we have signed heads over the years. To give an example, we've been going for 40 years. We've only invested in just about 50 brands.
Yeah.
Successfully exited 30. We're still in 13, 40. It gives you an idea of the stats there. If there was underhand tactics going on, you can easily find out about that. But no, certainly from a pipe perspective, what you've heard, why I love it so much is we spend so much time with founders, helping them get to the point. I think we've done all the education to them as well in the diligence of what to expect and how and what a typical term sheet looks like.
Yeah.
And it's got to be said a lot of the time, the brands we get involved with have had previous encounters of investment and term sheets, agreements whereby sometimes we're brought in to clear up the cap table.
Right. Yeah, makes sense. Let's imagine you've invested in a business. What are you looking from that investor-founder relationship? What are you looking from the founder? And also, what should the founder be looking out for and their expectations should be of the investor?
Really good question. I think let's answer that in two parts. Now, what are we looking for? So once we invested, complete transparency, trust, kind of our support. It's not just our internal expertise. We've got a phenomenal network that we can pull upon. And there's a lot of grey hairs, expertise, advice that we can give and debate, but with a lot of credibility and data behind it. So when we invest, we agree a kind of template, a cadence of board meetings. I think the minimum is 6 a year because as I said, we want to sell to strategic. So we want to start putting governance and a bit of change management in place to get to a point, because when that strategic looks at you, they're going to open up a data room and then we'll want every board pack every year. Yeah. There's a bit of knowledge learning. So yeah, we want a founder that A is hungry, but happy to take on recommendations from us, challenge us as much as we're going to, challenge them. But it's a true partnership. Okay. It's to have the open conversation about where do you want to be in 4 or 5 years? You want to be at the helm, or do you want to have a straight exit? If that is the case and it changes, so it's not prescriptive up front, so not by us, but if founders kind of say, I don't want to be there at the end, we got to think about, okay, that's great to tell us because that's being transparent. So we would turn around and say, right, well, ideally, is there someone that can step up to that CEO position that someone else can back? Okay. And if that is the case, we need kind of 18 months prior to an exit to get them in situ.
Yeah.
These difficult conversations to have because founders don't want to relinquish. They may want an exit, but we're kind of saying, look, you want a full exit, this is what you got to do. There's some home truths about their specialisms where they truly add value, where they lack, and how can we bolster? You've heard the adage of always hire people better than you. It's so true. Sometimes it's very difficult. That's what I meant about the trust transparency is not us trying to out you at all, is to get the best outcome from you. We've had scenarios whereby with every intention, we've gone down this route, but as you create plans and as you create the strategy, the business starts getting easier. Actually, the founder's going to go, actually, I'm in it for, you've done all the hard work. We've got the platform in place. I can see this for another 3 years. Actually, I'm going to stick in there. Yeah, that's absolutely fine. So absolute transparency. We want to help build the business. There shouldn't be any skepticism of what are we trying to get out of it. And as I said, you can only really understand that by referencing. And that's everything. So that was the first question. And the second part, what should founders be looking from an investor? And I think that, again, I can give you Piper's view and I can give first-hand view. And that's bringing something to the table more than cash. You can get cash anyway. Going back to the DNA of Piper, when the guy said that they access cash, if they had the expertise as well, they could have done it quicker, or they could have created something bigger. And that's ultimately what we want to do. Our purpose is to build brand legends. What you want from an investor is make sure that, actually, I talked about the due diligence bits, there's 5 areas. We want to strengthen those 5 areas because that's what's going to be looked at from the buyer. Outside of investment, we are, with a real focus, looking at all 5 areas, and hopefully we can help bring opportunity in all those areas from experience and from our network. You want a investor to actually make sure you're not being busy fools. What does a buyer want? Why are we deviating? I got an example whereby we were investing in a pet food brand at a double sales by doing on-label, street retailer. If we simply went to the strategics that we said in 3-4 years on, they're going to buy it. We went straight to them and said, how would you value this business? And they said, well, we'll only attribute a multiple to brand. We won't attribute any value to on-label. We're only interested in that. So actually being able to go back and saying, look, you don't need all the extra people. You don't need all the extra manufacturing capability. You're going to actually dilute the emphasis on building that true brand. And you're only valued on that. So you double business, you double the amount of people to actually help in manufacturing. You need to dilute the marketing to support the trade efforts, etc. Every minute, every hour, you're not thinking about where the value is being created. It's impacting the valuation of the business. So you want an investor that is thinking about the value at the end of the day. It shouldn't be primary because obviously there's other factors, but you don't want to be busy for getting to this. There's the other aspects that are happening in the background. You want to have an investor that has been through some tough times. We go 40 years, we go through ups and downs. We're not phased. It's always a cycle. You want to make sure it's in the best interest of the business. And for example of that, our typical investment is 4 to 5 years. There's always going to be curveballs. So there's always going to be headwinds. You want to make sure that with an investor that can be lenient when those times happen, because we can't influence external factors such as that. So you want to make sure that you've got a partner that you can truly trust, work with, because there's going to be tough times.
Yeah. Makes total sense. Thank you for that, Leon. Okay, so imagine a situation where you've now invested in the business, you're working in partnership with this person, they're getting out of you or Piper or private equity firm what they want, and you getting the same thing. Are there any patterns that you see in founders and the way they operate that gives you confidence that they're going to hit the numbers that they promised that they would?
Yes. And I think this part of the due diligence is making sure that you've got a founder that can keep track on the business and the metrics to make sure that they are on target, but also have the tenacity and grit. I want to use the word hustle, but actually it is, because in their minds, it's still a startup and you've got to be agile. And I think those businesses, the kind of patterns we see, it never gets corporate. There's the entrepreneur, but you need intrapreneurs as well to react. That's outside of promotional. It's saying at the crude level, we're not going to hit the numbers. Let's reevaluate our lapsed CRM because we need to get to X, and how are we going to deliver that? Is it a case of, right, guys, we've got to roll up our sleeves and look at businesses, consumers that have churned. How do we get them back in? How do we prevent churn? So I think it's the pattern where we've seen good outcomes and good leadership is being able to have an eye on every aspect of the business, and be able to adapt and react, and then embedding that as a leadership throughout the business. I focus on digital, but that could be operations. It could be an issue that pops up. It could be supply. It could be systems. It could be, but just be able to react very quickly because,
Yeah.
circumstances down the line,
Um,
embeds a great culture, hunger. And I suppose it is that hustle. You want to have governance, you want to put processes in place, but you can't lose that hustle that got you that DNA, because that's so critical to businesses and their success.
I'm going to throw a curveball at you. Retail and digital. Obviously, you come from a digital background, and I guess somewhat biased towards, but you've seen enough businesses and invested in enough businesses over the last decade and a half. In terms of valuations, a brand that's in retail and is also strong digitally, how do you view that? Do you feel like actually digital's more important, retail's less important, or the other way around? Like, what do these two different revenue streams, how do they play out from a valuation point of view?
Yeah, good question. And the thing, we invest in a lot of hospitality. I know it's not retail, but it's still consumer brand. So Yard Sale Pizza, we've got, I think it's about 13, 14 sites. We're going to roll out 40, a phenomenal brand. Some more to be. We had Hickories, Lounges we grew from 9 sites to 99 before we exited. Little Bay, La Siguana, we know bricks and mortar really well. Bar Brown, look at Vinida. You've got bricks and mortar, UK, US, Australia. So I think it comes down to the business model, and it comes to the consumer. We look up on the marketplace with Amazon. Is there a place? What's the halo effect of retail on internet? That's quite common. I want to speak to someone previously that, we had a bit of a hustle with Bowden back in the day. It's 400 million global. They did make more in the US than UK. But we challenged them at board whether you needed a capital intensive rollout, or can you gain the same amount from traditional web and direct marketing. And you went down the route, and the business model work. I think they are looking at flagships, but there's a time and a place. So I think you have to look holistically. I don't think we have any specific blueprint, but you can't argue that if you get the internet proposition correct, do you need bricks and mortar to support that? We've seen halo effects. Neon Wellbeing, good example. We've rolled out sites there. I was talking to a furniture business this morning. It's an online furniture business. You need a touchy-feely, go sit down, jump on it before you have an outlay of a couple of grand.
Yeah.
So I think it's all about the proposition. We certainly look at it as holistically. But I'll ask you, Raman, as if you're going to invest in something at a massive capital outlay versus something that is a repeat, low CAC, green position, where would you want to spend your time and money, knowing that you have to return money to your investors?
Yeah, thanks for putting me on the spot. Look, I'm digital through and through. I understand digital. I don't understand retail. I don't understand wholesale. So for me, it has to be digital. I have to make it work digitally. And if I can't make it work, that's telling me that I haven't got a product market fit. And then going into a retail will feel like a cop out. So yeah, for me, retail, I guess it's an extension. And I think to be fair, it's true for a lot of D2C brands where they will test the waters themselves, D2C first and foremost. And then as they start to get traction, they'll start thinking into, could we get into Tesco's and Sainsbury's, the supermarkets, the Holland and Barrett's and all the rest of it. So yeah, no, it's interesting. Ultimately, end goal is, let's say, to sell the business eventually, right? So from a valuation point of view, is a D2C brand that isn't in supermarkets, and I know that's a specific type of brand, but if a D2C brand isn't in supermarkets, does that actually going to lower the valuation, or does it actually really help with the valuation because they're already in supermarkets and I guess a more well-known brand relative to them being a pure D2C sort of pure play?
Absolutely. And you hit the nail on the head. What's left on the table? Investor. So you kind of want those proof points, which I mentioned earlier, to say, if we invest more, there's more to go after, or how to test the next kind of tranche of community, and that could be, grocer or not. And it depends on the proposition. right? So I mentioned furniture. For Vinida, sometimes you want to go in and buy a ring on, have a browse, look, but then you convert it to D2C, and that's what happens. It depends on the product. And again, Amazon, and online retail, you've got to take into account. Is it a channel of consumer? Yes, it is. I've been on record saying it's a necessary evil. You've got to play the game, whether that's format, whether it's quantity. And certainly I buy brands through Amazon, and it's got to be in the mix. But if you've got big, heavy capital injections where you don't, and commitments, long commitments, don't really need it, we're not going to frown on that. We will challenge if there's more to go after elsewhere.
What a fascinating chat. And as I often end these podcasts by saying, thank you so much for paying forward. Been absolutely pleasure speaking to you and learning so much about private equity and investment. And yeah, hopefully the listeners have found this one interesting. I guess last question from you, Leon, is before I let you go, how can people find you? Where can people find you?
Yeah, absolutely. All my details are on the Piper website. Please reach out, leon@piper.co.uk. I think if you've heard everything to date, you'll realize that I'm approachable. Please send in, regardless of level. I learn a ton. We can get you on the mailing list to be part of our community. Raman, as you know, we run a lot of events, and we want you to be part of the 378.
Brilliant. Thank you so much for your time.
Raman, really appreciate that. Cheers, mate.